The US Treasury yield surged to 4.19%, which is the highest since November last year. The Wall Street also impacted negatively. This led to the rise in Indian bond yields as well, which led to a bloodbath on D Street on August 2. Now you may be wondering why and how these bond yields are related to stock markets. Hello and welcome, I am Pallavi Sharma and you are watching Money Magic with ET Now, a show where we break down and simplify complex financial terms and concepts to help you with your finances. Today we tell you what are bond yields and bonds and also tell you how they are related to the stock markets. Let's begin. Let's first understand what are bonds and bond yields. Bonds are fixed income instruments and represent a loan made by the investor to the borrower. So when you purchase a bond, you are lending money to the bond issuers, which is the government in case of the government bonds and corporate companies in case of corporate bonds. Just like companies share their equities via shares, they also share their debt through bonds. So in short, bonds are units of debt issued by a company and are traded like stocks. Now what are bond yields? Just like when you take a loan from a bank, you have to pay an interest to them. These bond issuers who are borrowers here will be paying you an interest. This interest is called bond yields. It is the indicator of how much money you will earn from a bond or other debt instruments like loans. So higher the bond yields, the higher the return on investment. So yield is an effective rate of return that you will get when the bond matures and you sell it. A bond also pays you an annual return known as coupon payment, which is fixed until maturity. Now these bond yields and bond prices are inversely related. When the bond yields rise, the prices of the bond goes down. This is because the high yields, new bonds get more attractive and the older ones are offering lower returns on their investments. Now, why do yields rise? It depends on inflation and other economic factors. When inflation goes up, the bond prices are going down, which pushes the yields higher. It indicates the health of the economy. When investors sell the bonds, the prices will drop and the yields will rise, which spells a greater risk. And then equity markets will react to it. This brings us to how it affects the stock market. It's very simple. If the bond yields go up enough to beat the returns from stocks, then the opportunity cost of investing in stock goes up and they become less attractive to the investors. Well, think of you as an investor. You invest in stocks and they yield lower returns than the bonds that are giving you fixed returns. What will you do? It's obvious. Now, if the bond yields are going up, then it means that the debt market is getting more attractive. So if the Indian bonds are attractive at a particular time and they are offering more return than the global markets, FIIs will find Indian debt market more attractive than the global debt. If that happens, then bond yields are more attractive than equities, then FII flows will be bent towards equities. But there is a catch. Investors just don't look at the rising yield, they also look at why yields are rising. Mostly there are two reasons: growth and inflation. When the growth is strong and the yields are rising, the cash flows and the future earning estimates also improve. This offsets the negative impact of the rise in discount factor and overall impact of the equities become very positive. But when inflation pushes the bonds higher, the growth is not very strong and the impact on equities is negative. Now, how does a high yield affect the discount factor? Because every equity market has a valuation and it is determined mostly by discounted cash flow method. The calculation uses cost of capital in the denominator, which is weighted average of cost of equity and cost of debt. The cost of debt is filled in by the 10-year bond yield of the government. So the yields rise and the cost of capital also rises. which reduces the returns and makes the equities unattractive. So well, that's all about how stock market reacts to bond yields. Keep watching ET Now for more such informative videos.
If you like this video, then like, share and subscribe to ET Now.